Someone is going to tell you that renting is throwing money away. And the worst part is, you might already believe them. Maybe it's your parents dropping hints at Thanksgiving about how you should build equity instead of paying someone else's mortgage. Maybe it's a coworker who just closed on their first home, posting about it on Instagram like they just won the Super Bowl. Maybe it's that quiet voice in your own head whispering that you're falling behind, that you're doing life wrong. Here's what nobody in that conversation is telling you: the math behind homeownership is a lot uglier than the dream they're selling. Because when you actually run the numbers, the real numbers, not the ones the mortgage broker shows you, renting might be the smartest financial decision you make this decade. Let me give you a statistic that stopped me cold when I first saw it. On a $400,000 home with a 3-0 year fixed mortgage at 7% interest, you will pay back over $950,000 by the time it's done. That's not a typo. You borrow $400,000 and you return nearly $1 million to the bank before you fully own a single square foot. And that's before property taxes, homeowners insurance, PMI if your down payment is under 20%, HOA fees if you're in one, and the maintenance costs that every homeowner conveniently forgets to mention. The standard rule of thumb in real estate is that maintenance alone costs between 1% and 2% of your home's value every single year. On a $400,000 house, that's $4,000 to $8,000 a year just to keep the thing from falling apart. So before we even talk about whether the home goes up in value, you are already committed to a financial obligation that most people have never fully calculated. But here's where I want you to slow down and really sit with this, because this is the part that changes everything. When you buy a home, you don't just spend money on the mortgage, you lock up a massive chunk of capital in an illiquid asset that you cannot easily touch. Let's say you scrape together an $80,000 down payment, which is a 20% down payment on that same $400,000 home. That $80,000 is now gone, sitting inside the walls of a house, not working for you in any meaningful way until you sell. Now here's the question nobody asks at the closing table. What would that same $80,000 do if you invested it in a diversified index fund instead? At a historical average return of 8% annually, that $80,000 grows to over $862,000 in 30 years. That's the opportunity cost of your down payment, the silent, invisible price tag that never shows up on any mortgage document. And while your house might appreciate too, the average home in America historically appreciates at about 3% to 4% per year, roughly in line with inflation, which means in real terms, you're barely breaking even on the asset itself. Now, I know what you're thinking, but what about building equity? And look, equity is real. I'm not going to pretend it isn't, but equity is also the most illiquid, inaccessible form of wealth you can build. You can't pay your grocery bill with equity. You can't use your equity to invest in an opportunity that shows up tomorrow. You can't tap into your equity without either selling the house or taking on more debt in the form of a home equity loan. Equity is wealth that's trapped inside an asset you need to live in, which makes it fundamentally different from the kind of flexible, liquid wealth that actually gives you options in life. Here's something the personal finance world doesn't talk about enough, and I think it's one of the most underrated financial advantages of our generation. Flexibility is a financial asset. When you rent, you can move to the city with the best job opportunity without losing 6% of your home's value in realtor fees. When you rent, you can downsize instantly if your income takes a hit, instead of being anchored to a mortgage you can no longer comfortably afford. When you rent, you don't lose sleep over whether the roof needs replacing or the HVAC system is about to die, because that's your landlord's problem, not yours. The ability to move, adapt, and stay financially nimble is worth real money, and the people who underestimate it are usually the ones who bought a house in a city they ended up leaving 2 years later and got crushed by transaction costs on the way out. Now let's talk about the rent and invest strategy, because this is where renting stops being a consolation prize and starts being an actual wealth. building machine. The idea is simple. Calculate the difference between what you would spend on homeownership, mortgage, taxes, insurance, maintenance, and what you're actually spending to rent a comparable home in your market. In most major cities right now, that gap is significant. Renting is meaningfully cheaper than buying on a monthly basis, often by $800 to $1,500 per month. Take that difference and invest it every single month without touching it. If you're banking $1,000 a month into a broad market index fund earning 8%, annually, after 30 years, you're looking at over $1.4 million. You built 7 figures of liquid, accessible, diversified wealth without a single call to a plumber, without a property tax bill, and without betting your entire financial future on one piece of real estate in one zip code. Let me pause here and be fair, because I'm not here to tell you that buying a home is always wrong. That's not the truth, and you deserve the full picture. Buying a home makes a lot of sense if you're planting roots in a city you know you'll stay in for at least 7 to 10 years. It makes sense if you find a property that cash flows well, if you're purchasing below market value, or if you're in a specific market where buying is still genuinely cheaper than renting on a monthly basis. And yes, there is a psychological value to owning your own space stability, customization, roots that's real, and it matters for some people's quality of life in a way that can't be reduced to a spreadsheet. But here's the critical distinction that most people miss entirely. Buying a home can be a good life decision without being a great financial decision, and knowing the difference is everything. The cultural story we've been sold is that renting is for people who haven't figured it out yet, that homeownership is the finish line of financial adulthood. But that story was written in a different era with different interest rates, different price to income ratios, and a different economy than the one you are actually living in right now. In 1980, the average home cost about 3 times the average annual income. Today, in most major markets, that ratio is closer to 7, 8, or even 10 times the average annual income. The game has changed, and the rules your parents followed don't automatically apply to the board you're playing on. The smartest renters I know aren't renting because they can't afford to buy. They're renting because they've done the math, they understand the opportunity cost, and they've made a deliberate, strategic decision to build wealth in a way that works with their life, not against it. They're not throwing money away, they're paying for shelter, flexibility, and the freedom to keep their capital working in places where it can grow faster and more efficiently. That's not failure, that's financial intelligence. And if someone at Thanksgiving tries to tell you otherwise, now you have the numbers to answer them. If this video made you think differently about renting versus buying, hit the like button. It genuinely helps this channel more than you know. And if you want to go deeper on how to actually build wealth while renting, subscribe, because that's exactly what this channel is about. I'll see you in the next one.